Welcome to this explainer. Today we're diving straight into the incredibly alluring world of 0% interest and no-cost EMI offers to figure out what's really happening behind the scenes. You know the drill, right? We've all been there, standing at a checkout counter or browsing an online cart, and boom, a banner pops up. It offers to split your massive purchase into easy, interest-free monthly payments. I mean, it sounds like an absolute financial no-brainer. But today, well, we're going to look at the actual math, the tiny fine print, and some hard consumer data to uncover the reality of these deals.
So, the big question, is 0% interest actually free money? We've all seen those highly targeted ads for 0% financing on everything from, a new couch to expensive dental work to online shopping. But is it really free, or is there a catch hiding in the shadows? Here's the thing. The financial industry is built on making a profit. Lending money for absolutely nothing doesn't exactly fit that business model, does it? When we actually dig into the data from consumer protection agencies, a much more complicated and honestly sometimes pretty dangerous picture starts to emerge. Just look at this real complaint submitted to the Consumer Financial Protection Bureau. This person used a medical credit card for emergency dental treatment. They did everything right, diligently making payments for an entire year. But then they checked their statement and realized their balance had suddenly shot up by hundreds of dollars. Without warning, their supposedly interest-free rate had rocketed to 26.99%. Basically, nobody told them, and they unknowingly walked right into a massive hidden trap. That nightmare scenario perfectly illustrates what the National Consumer Law Center calls a hidden time bomb. And guys, this bomb is sitting in millions of wallets right now. These 0% promos really prey on a psychological quirk called hyperbolic discounting. It's just human nature. Life happens. We tend to overvalue the immediate, right-now benefit of getting a new TV or finally getting that medical procedure done. At the same time, we completely undervalue the potential future costs if, say, we hit a financial emergency, like a job loss down the road.
Section 1. The 0% illusion. Let's break down why that 0% sticker is often just a mirage.
To really protect your wallet, you absolutely have to understand that not all 0% offers are created equal. Mixing these up can literally cost you a fortune. The absolutely crucial difference is between true 0% APR and deferred interest. With a true 0% APR offer, the kind you usually see from major bank credit cards, you only pay interest on whatever balance is left over after the promotional period ends. Pretty straightforward, but deferred interest, which is super common with store cards or medical financing, well, that's a different story. Interest is secretly ticking away in the background the whole time. If you owe even $1 single when the promo expires, bam, that accumulated interest is retroactively slapped onto the entire original purchase amount.
Seriously, if you ever check the fine print and spot the phrase, "no interest if paid in full," watch out. You are staring right at a dangerous deferred interest trap. That tiny word "if" is the ultimate red flag. It essentially means the interest was never actually zero. It was just waiting to pounce. And experts point out that on a promotion lasting, say, 12 to 24 months, that retroactive interest charge can easily amount to a massive 25 to 50% of the original purchase price, all hitting your account in one gigantic, painful lump sum.
And look, this setup is so complex, it catches even highly educated professionals completely off guard. Take this case. A young lawyer bought a $6,000 engagement ring on a promotional card. He was responsible, diligently paid off $5,000 over the year, but he missed the final deadline. So he was retroactively hit with $1,760 in interest at an insane rate of 29.99%. Think about that for a second. He actually ended up being charged interest on the $5,000 he had already paid back. Crazy, right?
Section 2. Who actually pays for this? Let's take a look at who's really footing the bill here.
So, if millions of people are supposedly getting this 0% financing, who is actually funding the massive profits for these credit card companies? Well, the numbers reveal a pretty clear and honestly concerning disparity. Look at this cross-subsidization. Deep and core subprime consumers, meaning folks with the lowest credit scores, they only make up 11% of the purchase volume. Yet they pay a staggering 24% of the deferred interest charges. On the flip side, superprime consumers make up 66% of the volume, but pay less than a third of the interest. The whole system is literally designed so that financially vulnerable consumers end up subsidizing the wealthy ones who get a free ride.
The data clearly shows that the most economically vulnerable people just get absolutely hammered by this. For instance, take this cash-strapped college student who needed surgery. The medical facility heavily pushed a promotional card, making it sound like a super helpful financial lifeline. But when that promotional period expired unnoticed, the student got hit with a 26% interest rate penalty on a $3,000 bill. They calculated that if they just stuck to the minimum payments, it would take them 7 agonizing years to pay off that surgery. Just imagine the financial stress that causes.
Section 3.
The No Cost EMI truth. Let's shift over to the online shopping world.
We see these heavily promoted no-cost EMI or equated monthly installment offers all the time, right? Especially on platforms like Amazon or Flipkart for big-ticket electronics. The upfront price tag is huge, but dividing it up makes it look incredibly affordable. But here's the reality check from financial experts. Banks absolutely never lend for free. Behind the scenes, they're usually charging around 9 to 14% interest. So how is it no cost to you? In this scenario, the dealer or manufacturer is actually just cutting their own profit margin to absorb that interest cost. And why on earth would they do that? Simple. They desperately need to clear out old warehouse inventory before the shiny new models drop. By taking a slightly smaller profit, they move a massive volume of products. It's a highly calculated business move, not a favor to your wallet.
But the real hidden danger here is self-trapping. Every time you take on these EMIs, they actively lock up your credit score, which is often called your CIBIL score in many international markets. Every single time you click accept on a no-cost EMI for a luxury gadget, it increases your overall debt obligations. So what does this mean for you? Well, if you suddenly need to apply for a major, life-changing loan, like buying a house or a car, your eligibility drops. Or even worse, your bank might only offer you a much higher interest rate because your credit profile looks stretched way too thin. You are quite literally trading your future borrowing power for today's shiny new toy.
Section 4. The minimum payment trap. How the statements are designed against you.
Now, what's genuinely fascinating and a bit devious is how these lenders strategically handle your monthly bill to make you fail. Even if you completely understand the rules of the game, the actual design of your monthly statement is built to trip you up. During that sweet 0% period, credit card companies often set the minimum payment incredibly low. We're talking just 1 or 2% of the total balance. When there's no interest piling up, the urgency to pay the whole thing down just evaporates. I mean, it feels great in the moment to only owe $80 a month on a $4,000 purchase, right?
But guys, this is a deliberate math trap. Making only the minimum payment pretty much guarantees that you will fail to pay off the balance before the promotional expiration date. Let's do the math real quick. If you charge $4,000 on a 15-month promo, you need to pay about $267 a month to clear it in time. But if you trust the credit card company and only pay their tiny 2% minimum, you are going to cross that expiration finish line still owing almost $3,000. And that, of course, triggers the retroactive penalty.
And when that retroactive interest finally hits, the average penalty rate is a staggering 24%. It just wipes out all your assumed savings in an instant. And remember how deferred interest works? That 24% isn't just applied to the $3,000 you still owe. Nope. It is calculated retroactively against the entire original $4,000 purchase, dating back over a year. Just brutal.
Section 5. Escaping the debt bomb. Let's talk about how to get out of this.
So the absolutely crucial point is, how do you navigate or escape this debt time bomb before it completely blows up your finances? If you're sitting on a promotional balance right now, especially if you're within 90 days of expiration, experts have a very specific playbook for you. Step 1. Ignore their minimum payment entirely. You've got to calculate your true payoff math. Just divide your total balance by the exact number of months remaining on the promotion. Once you have that magic number, set up a fixed aggressive autopay for that amount immediately. Do not rely on your memory to log in and pay it. Also, if you get any extra cash, like a tax refund or a holiday bonus, throw it at the principal as a lump sum payment.
Step 2, you have to stop treating the 0% window as free money, and absolutely do not, under any circumstances, make new purchases on that promotional card. Why? Because of tricky payment allocation rules. If you buy something new, the law generally requires any payments over the minimum to be applied to the highest interest balance first. That is almost never your deferred interest balance until the final 2 months. It makes it nearly impossible to allocate your payments right and avoid the retroactive trap. Honestly, just put the card in the drawer and forget about it.
Now, what if you are 90 days out and the math just simply won't work? If you don't have the cash to clear the balance in time, you need an escape route fast. One option is to transfer the debt to a true 0% balance transfer card from a major bank, though keep an eye out for that 3 to 5% transfer fee. Another route is taking out a fixed-rate personal loan. Those usually sit between 8 and 14% APR, which is still vastly better than eating a 26% penalty. And finally, don't be afraid to just pick up the phone. Call your issuer and aggressively negotiate to see if they'll grant you a hardship extension, or at least a lower fixed rate.
All of this brings us to a final, provocative thought to leave you with today.
These promotions can actually be useful tools, but only if you are highly disciplined, do the math up front, and set up strict automated payments. Ultimately, they are heavily engineered to capitalize on human error and unexpected financial emergencies. So, the next time you are offered an unbelievable deal at the checkout counter, stop, read the fine print, and ask yourself, are you using 0% financing, or is it using you? Thanks for joining me for this explainer, and stay financially vigilant out there.